The numbers say the economy is growing, but if that's true, why does life feel tighter every year? Not falling behind, not failing, just staying in the same place. GDP is growing, employment levels are high, average incomes, on paper, are higher than they were a decade ago. Governments repeat this message constantly, central banks confirm it with charts, financial media echoes it every quarter. By every official measure, progress is happening, and yet, for many people, life feels tighter. Not freer, more constrained, not more secure, not because of extravagance, not because of bad decisions, but because one basic expectation has quietly slipped out of reach: owning a place to live, not a luxury home, not a speculative investment, just a roof that belongs to you. For most of the 20th century, this wasn't an ambitious dream. It was a milestone most working households expected to reach. In many developed economies, the price of a typical home hovered around 3 times the annual income of a household. 3 years of income. That was the rule of thumb. It wasn't easy, but it was possible. And more importantly, it was normal. Today, that reference point barely exists. Across major global cities, housing prices now sit at 5, 7, even 10 times household income. In some places, far higher. A comprehensive global study tracking 95 major cities found something unprecedented. Not a single one can now be classified as affordable by historical standards. Pause on that. Not just expensive cities, not just global hubs, but virtually everywhere that once promised opportunity. Cities that grew precisely because ordinary people could build a life there, now rank among the least affordable places on earth. In Hong Kong, average home prices exceed 14 times median household income. In Sydney, the ratio is close to 14. In Vancouver, well into double digits. In parts of East Asia, the gap stretches even further. In cities like Beijing and Shanghai, price-to-income ratios have at times exceeded 20, even 30 times income. Levels that would have sounded absurd just a generation ago. Even in the United States, long associated with suburban expansion and relatively accessible housing, the shift is unmistakable. Before the pandemic, the national house price-to-income ratio sat around 3.9. Today, it is closer to 4.8. And in major metropolitan areas, far above that. This didn't happen overnight, and that's part of why it's so hard to name. There was no single crash that made headlines, no obvious moment when housing broke. Instead, year by year, prices moved slightly faster than incomes, mortgages stretched a little longer, down payments grew heavier, debt quietly filled the gap, until one day, people looked up and realized the old math no longer worked. 2 people working full-time jobs, stable employment, no extravagant lifestyle, and still, ownership remains out of reach. What sharpens the disconnect is how the same period is described officially. Economic output is up, corporate profits are strong, asset values have surged. By the metrics that dominate headlines, the system appears healthy, but daily experience tells a different story. You can see it in delayed family formation, in adults living with parents well into their 30s, in workers commuting farther and farther from the cities they serve, teachers, nurses, service workers, the people who keep urban economies functioning, increasingly cannot afford to live where they work. This is not a story about irresponsibility or poor financial decisions. It is happening across income brackets, across professions, across countries, which raises a deeper and more uncomfortable question. If the economy is growing, if incomes are rising, if employment is strong, why does one of the most basic foundations of economic security feel increasingly unattainable? And more importantly, what actually changed? Because whatever the answer is, it doesn't sit inside a single statistic, it doesn't show up cleanly on a quarterly report, it lives in the widening gap between what the numbers say and how life actually feels. If rising incomes were the full story, housing affordability should have improved, but the numbers refuse to cooperate. Over the last 3 decades, median household incomes in most developed economies have increased steadily, not explosively, but consistently. In the United States, median household income rose from roughly $35,000 in the early 1990s to over $75,000 today. In Europe, wages followed a similar upward path. Adjusted for inflation, the gains are smaller, but they are real. Now compare that to housing. In the same period, average home prices didn't rise steadily. They accelerated. In many cities, prices doubled, then doubled again, far outpacing income growth. This isn't anecdotal. It shows up clearly when the two lines are placed on the same chart. Income climbs like a gentle slope. Housing prices curve upward like a ramp, and the gap between them widens year after year. Economists summarize this gap using a simple metric: the price of a home divided by annual household income. For decades, that number hovered around 3. Today, across most of the 95 cities tracked globally, it sits above 5. In 12 of them, it has crossed into a new category: homes costing more than 9 times income. At these levels, traditional assumptions break down. A household can no longer save its way into ownership. The timeline stretches beyond a working decade, sometimes beyond a lifetime. At this point, the explanation usually shifts. Interest rates. For much of the last 20 years, borrowing costs collapsed. In some countries, mortgage rates fell below 3%. In others, real rates hovered near zero. But low interest rates don't just help buyers, they change how assets behave. If you can borrow at 3% while housing rises 7% a year, you don't need wages to justify the price, you only need prices to keep rising. And households aren't the only buyers. Homes are increasingly purchased by investors, funds, corporations, institutions managing pensions and insurance capital. When trillions of dollars search for yield in a low-rate world, they move into assets that are scarce, protected, and politically insulated. Housing fits perfectly. Meanwhile, supply doesn't respond. Zoning limits, height caps, parking requirements, years-long approval processes. In many cities, bringing new housing online can take a decade or more. So price increases don't relieve pressure, they concentrate it. Which brings us back to the contradiction. Income rises, but not fast enough. Interest rates fall, but prices rise faster. Supply exists, but cannot move. Each factor makes sense alone. Together, they don't resolve. And this is where most explanations stop. But the timing doesn't. Affordability deteriorated almost everywhere after the 1990s. Even in cities with stable populations. Even in countries with different cultures and policies. Different inputs, same outcome. Which suggests the problem isn't effort or desire. It's structural. Housing stopped being priced primarily for living and started being priced for something else. At some point, money stopped looking for work. It didn't announce it. It didn't require a policy decision. It simply followed incentives. For most of the 20th century, capital flowed primarily into production. Factories, infrastructure, businesses that hired people and made things. Returns came from growth. But over the last few decades, something shifted. Growth slowed. Productivity gains became harder to extract. And yet, the amount of money in the system kept increasing. Not gradually, exponentially. Central banks injected liquidity to stabilize crises, then injected more to prevent recessions, then more to fight deflation. Each intervention made sense on its own. Together, they changed the behavior of capital. When money becomes abundant, its primary problem is no longer how to grow, but where to hide. Because excess money is unstable money, if it sits idle, it loses value. If it takes risk, it faces volatility. So it looks for assets that are scarce, legally protected, widely accepted as stores of value. Housing checks every box. It's not just shelter. It's land, zoning rights, legal permanence, and leverage bundled into one object. And crucially, it can absorb enormous amounts of capital without obvious limits. This is where the logic breaks from everyday intuition. Most people think of houses as things people buy. The system increasingly treats them as places, money, parks. When interest rates fall, the math becomes unavoidable. Borrow at 2-3%, buy an asset that rises 6-8% a year. You don't need rent to justify the purchase. You don't need wages to support the price. You only need prices to keep rising. And as more capital enters the same asset class, prices rising becomes the reason more capital enters. This is not speculation driven by optimism. It's allocation driven by structure. Pension funds, insurance companies, sovereign wealth funds, they don't chase excitement, they chase stability. Housing offered something rare: steady appreciation, inflation protection, and political insulation. So money moved in, not in one wave, in layers. First from households leveraging cheap mortgages, then from professional investors buying rental portfolios, then from institutions accumulating exposure at scale. Each layer pushed prices higher, not because people suddenly needed more homes, but because capital needed somewhere to go. Meanwhile, wages stayed anchored to productivity, and productivity did not explode, so the link between income and housing quietly snapped. From the outside, it still looks like a housing market. People buy, people sell, mortgages get approved, but underneath, pricing is no longer governed by local earning power. It's governed by global liquidity. That's why affordability collapsed simultaneously across cities with nothing else in common: different demographics, different regulations, different cultures, same outcome. Because the force acting on them wasn't local, it was systemic. And here's the part that rarely gets said out loud. Once housing becomes a financial sink, high prices stop being a bug, they become the feature. Rising prices validate prior buyers, they justify leverage, they stabilize balance sheets. Falling prices, on the other hand, threaten everything layered on top of them: banks, funds, pension assumptions, household wealth. So the system learns, informally but decisively, to prevent prices from falling, not through a single rule, through many small ones: supply restrictions, tax incentives, buyer subsidies, emergency liquidity. Each measure appears neutral, even helpful, but together they form a bias upward, which leads to a strange outcome. An economy can report growth, wages can rise, employment can look strong, and yet the core asset needed to anchor a middle-class life moves on a completely different axis. At that point, effort no longer explains outcomes. Timing does, ownership does, entry point matters more than contribution. And for those arriving late, the system doesn't feel competitive, it feels closed. But this still doesn't answer the hardest question. If housing is now priced by money flows rather than incomes, what happens when those flows slow, reverse, or collide with limits? Because capital can inflate assets for a long time, but not indefinitely, every system built on leverage eventually encounters friction. The only uncertainty is where it appears and who absorbs it. By the time housing becomes unreachable, the damage is no longer just financial. It quietly rewires how society moves. When people can't afford to live where the jobs are, they stop moving for opportunity. Teachers stay where housing is cheaper, not where schools need them. Nurses commute hours instead of relocating. Tradespeople turn down work because relocation costs more than the pay increase. A housing market that doesn't move creates a labour market that doesn't move either. Economists have a term for this: labour immobility, but for most people it feels simpler than that. It feels like being stuck. In the United States and Canada, the average first-time homebuyer is now nearly a decade older than their parents were. In many global cities, renters routinely spend 30 to 35% of their income just to stay housed, right at the line economists define as unaffordable. At that point, saving stops being a plan, it becomes a gesture. And when enough people stop believing that effort leads to stability, the system doesn't collapse, it stiffens. Workers don't quit, they endure. Families don't expand, they delay. Cities don't grow, they hollow out. Productivity slows, not because people work less, but because the friction of daily life gets heavier every year. Meanwhile, those who already own property experience the opposite reality. Their wealth rises automatically, not because they produced more, but because scarcity did the work for them. Globally, real estate is now worth roughly 3.5 times the world's annual GDP. And that gap between asset growth and lived experience is where tension accumulates. For those who manage to buy in late, the reward is not security. It's exposure, high debt, thin margins, and the constant awareness that one economic shock could undo decades of effort. So when official data says the economy is growing, and incomes are rising, and balance sheets look healthy, but daily life feels tighter, slower, more constrained, that isn't a contradiction, it's a signal. Because historically, systems don't break when people panic. They break when people adapt for too long. And the longer a society learns to live inside something that doesn't work, the harder the eventual adjustment becomes. That adjustment never arrives evenly, and it never announces itself in advance. It simply shows up after mobility is gone, after choices have narrowed, and after most people have already adjusted their lives downward.